Welcome to Deep Dive into the most compelling economic rivalry in modern Asia, China versus Japan. The data you see is not just about numbers, it's a story of contrasting economic philosophies. For decades, the Japan line dominated, representing an economic miracle. Then an unprecedented shift occurred, and the China line began its monumental ascent. The real question is, what strategic choices caused this dramatic divergence on the chart? Let's rewind to the 1980s. The Japan line at the top reflects an economy built on precision, quality, and technological mastery, the Japan Inc. model. Their growth was fueled by exports of high-value goods like automobiles and electronics, driven by strong domestic savings and disciplined corporate governance. Japan's strategy was deep, excelling in niche, high-margin sectors. But this success relied heavily on predictable global trade and a rigid seniority-based employment culture that would later stifle innovation. As we move into the 1990s, notice how Japan's line flattened significantly. This period, known as the Lost Decades, was characterized by deflation, asset bubbles bursting, and a corporate sector unable to adapt quickly. Crucially, demographics played a silent, heavy role. Japan's aging population and shrinking workforce meant less consumer spending, less innovation, and a massive tax burden. The nation, once the world's fastest mover, became paralyzed by its own structural rigidity and demographic clock. Now, look at the China line, starting its parabolic climb around the turn of the millennium. China's strategy was diametrically opposite to Japan's. It was wide. Their growth was based on scale, infrastructure investment, and labor abundance. The 2001 entry into the WTO opened floodgates for foreign investment, turning China into the world's factory. This growth was not fueled by efficiency alone, but by a massive, centrally planned injection of capital into roads, ports, and manufacturing capacity. While the output numbers exploded, this model created internal challenges: overcapacity, reliance on debt, and severe environmental issues. The moment the China line surpasses the Japan line is more than just a data point. It represents the victory of scale over structure. China's sheer volume of production and population size, despite lower per capita output, allowed its aggregate economic output to dwarf Japan's. Japan focused on optimizing existing wealth. China focused on maximizing new production. This crossover highlights a fundamental philosophical difference. Can an economy sustain growth through central planning and sheer size, or must it rely on organic, demographic-constrained innovation? Looking at the projected data through 2030, the gap widens. However, both nations face profound structural challenges. China now grapples with its own demographic crisis, a rapidly aging society following the one-child policy, and massive debt. Meanwhile, Japan has finally started embracing corporate reforms and investing heavily in automation to offset labor shortages. The chart tells us the past, but the future of both lines will depend on how successfully they navigate their respective demographic and debt traps. This chart is a powerful lesson in economic resilience and risk. The Asian economic landscape has been rewritten. What are your insights into the next 5 years? Will China slow down, or can Japan find a second wind? Share your thoughts in the comments below. If you enjoyed this detailed analysis, hit the like button and subscribe for more deep dive comparisons. Will China's momentum continue, or can Japan innovate its way back? Share your thoughts on this GDP battle in the comments below, and don't forget to like and subscribe for more data deep dives.